Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Good to be back for another podcast, Bills.
Andrew, it's always good to be here. And I was just thinking about this before we hit the record button on the microphones here, that the intro is always the same. And the reason why it's always the same, because hopefully it comes across honest and genuine, but we actually really love and enjoy being in here and doing these. And it sounds like it's the same every time and we're all upbeat and jovial and stuff, but we actually love being in here and doing this. So
that's because we're always excited, Billy. That's why.
That's it. So Andrew, run us through what are we talking about today? Because I reckon this one's going to prick the ears of a lot of our listeners because it's quite a topical topic all of the time, it seems to be. But we're totally fitting and relevant to talk about it at this point in time.
Yeah, so today's a bit of a property masterclass, how to get into property, how to, effectively go about purchasing a property. And we'll be touching and talking about sort of the key things and the key areas that we think ultimately very important for people to understand when, you're looking at purchasing a property. So I guess it's kind of more relevant to first home buyers just because it's, an area that most first home buyers haven't had much experience with. But all the things that we're talking about is ultimately relevant to anyone that's purchasing a property.
Well said. And just on that first home buyer topic, some of the challenges or some of the obstacles to get into property, which we're going to cover in a sec anyway, but those obstacles seem to be a bigger consideration for first home buyers. So probably the first thing that the hurdle that we need to jump through, I guess from a property perspective, is pretty straightforward and most of our listeners would know this. It's just getting a deposit up to be able to put down towards the property, because when you purchase property, yes, you can go to the bank and borrow money, but you need to have some of your own money to be able to put down towards that property. You're not going to be able to borrow 100% of the value of the property. No bank will lend that to you.
Yeah, exactly right. I guess the other thing to kind of note on the deposit is a lot of the times banks will require an element of that to be genuine savings. So obviously, double check with your bank, your mortgage broker, whoever's assessing the loan as to, what the exact requirements are. But ultimately, you need to make sure that you can't just have a huge lump sum of money that comes in and that's it. Most banks will require an element of that to be actual genuine savings that, you've put aside yourself to count towards the deposit as well.
And the challenge that we see with this too is that saving for a deposit is hard. I mean, it's, it's the money that you're putting aside after you've met all of your living expenses and all of your commitments. But the other challenging part that you go and add on top of this is property prices, at least what we've seen of late in and around the country, in most capital cities, is that the price of the houses are growing faster than what people can save for a deposit. So you're always sort of ever chasing this target that's getting bigger and bigger and further away, which makes it all that more frustrating for people looking to get into the property market.
Yeah, and look, it's something sort of to talk about as we sort of progress this, but a lot of the questions that we're getting is, do I just bite the bullet, have less of a deposit, and leads into the next topic of conversation or sort of the next point, which is LVR and mortgage insurance and all of that stuff. But do you just get into it earlier because you're better off being earlier and riding that wave in terms of property prices increasing? Or are you better off, continuing to save? Each situation is different, but some of the concepts we'll sort of talk about as we go into this podcast and delve a little bit deeper.
Good segue. Let's talk about loan to value ratio. So loan to value ratio, or LVR as the acronym is, pretty straightforward. The loan of the property, what is that expressed as a percentage in terms of the value of the property? Anytime that's above 80%, which seems to be the generic number that lenders have. So essentially that means that you own or have 20% of equity in your property and the other 80% is a loan. So from the bank's perspective, obviously the lower that number, the more security or the more equity that they have in that property. So they feel a greater sense of comfort lending to people who have a lower loan to value ratio, because if there's any shocks in the economy or if there's any issues with your personal circumstances and for whatever reason the property needs to get sold and the loan needs to get paid back, there's enough, I guess, fat in there to be able to ensure that that can happen. So at that 80% loan to value ratio, Andrew, you want to talk us through what happens if we borrow more than that?
Yeah. And look, sort of taking it just one step back for a second, if you're looking at, loan to value ratio, just to sort of give a bit of context and a bit of an example, if you're purchasing a $500,000 property and the loan is $400,000, then your LVR is, because 400,000 divided by 500,000 is 80%. So that's how you're calculating that. And again, I seem to be jumping back and pulling back, but everything's sort of intertwined. One thing to kind of be aware of that as well is if you're purchasing a $500,000 property, it's not just the purchase price of the property versus the loan that you're going to get. There's also stamp duty involved as well. So when you're calculating your LVR, it's not just, I've got a $100,000 deposit, I'm not going to need to pay mortgage insurance. It's a $100,000 deposit plus whatever the stamp duty is on top of it. So if as a result of stamp duty or if as a result of your deposit, you don't have the full 20% deposit, as Billy was saying, what the bank will basically force you to do is pay mortgage insurance in order to cover some of the risk associated with the bank. So any LVR over 80%, you're paying mortgage insurance, but obviously certain conditions, there's certain occupations and incomes and things like that. But most of the time, you're paying mortgage insurance if your LVR is over 80%.
On that mortgage insurance, just to clarify, it's an insurance premium that you're paying because you're borrowing more money than the bank doesn't feel comfortable with, but they're starting to get into the territory where there's less equity in the property. And you're paying for an insurance premium. And I always love this one because I guess it's often overlooked, but you're paying for an insurance premium that in the event that you need to claim on that policy, you're never the beneficiary of. So what I mean by that is if you can't meet your mortgage repayments, you've paid lender's mortgage insurance and the bank decides to foreclose and sell your property, if there's a shortfall in terms of they sell the property for less than what is owed to the bank, the lender's mortgage insurance is designed to kick in to pay the bank the shortfall or the difference between what it sold for versus the amount of the loan that's outstanding. So it's not actually an insurance premium that you benefit from directly. Obviously, you don't want to be in that position anyway because it means that something really bad has gone on and you've lost the house or the property. But it's always very interesting when you think about it from that perspective because you're paying for a premium or an insurance that you're actually paying for that to add more protection for the bank. Yeah.
Yeah, a bit of a weird one there, but I mean, I guess it's one of the requirements if you're purchasing the property, and so you don't ultimately, or the bank doesn't give you any choice in that matter. It's just one of those things that unfortunately or fortunately you need to pay. But kind of begs the question, and taking it one step back and obviously sort of a bit more of a, information now when we're talking about it, but what do you do, Bills? You're a first home buyer, you've got a 10% deposit, mortgage insurance is going to cost you X. Do you just pay the mortgage insurance and purchase the property and you're in the market? Do you wait and save up so that you've got the full 20% deposit so that you don't need to pay mortgage insurance? What do you do?
Very loaded question. The short answer,
I'm throwing you into the firing line.
The short answer is, it kind of touches on what I had described before, where the growth, if we're in a market that's growing, but it seems to be that the growth of the property market or the property prices seem to outstrip your ability to save. Mortgage insurance, although it's only an issue that's a short period of time, and what I mean by that is if you're over 80% loan to value ratio, in a handful of years, you'd think that the property price has gone up, you've paid down some debt, you're not in LMI territory anymore, so you're less than 80% loan to value ratio. This is actually a premium that you pay, the insurance premium that you pay that gets added on top of the loan for the life of the loan. So you're paying for something which is an interesting thing within itself, but you're paying for something for the entire loan that you only need for a short period of time. Put that aside, because you can add mortgage insurance, the mortgage insurance premium onto and into your repayments, in my experience, most of the time, it's always better to get into the property market earlier, pay that mortgage insurance. And obviously you need to be aware of cost and, making sure that you're comfortable enough with that. But when you factor in how much additional it's going to cost you in repayments per week, per month, per fortnight, however you calculate your repayments, the difference to pay that is almost negligible, where you'd have to consider it a serious option because it means getting into the property market faster. And because you only conduct that type of transaction a handful of times in your life, if you're lucky, I think the sooner you can pull that trigger and the sooner you can get in, the sooner, it's a no-brainer from my perspective for the majority of the time.
Yeah. So a matter of looking at each individual circumstance, looking at your savings rate, looking at the rate of growth of property, but assuming that, property's on the trajectory that it currently is or has been in the past, you're better off just riding the wave in terms of property prices, biting the bullet, swallowing your, pride and paying the extra money for the mortgage insurance, because while you're in the market, you're riding the wave of effectively the rise in property prices. And hopefully in a short period of time, you're out of LMI territory, as you were saying, and you've got the ability to refinance the mortgage if you wanted to reduce the repayments. You've got the ability to pull equity out and buy a second property or whatever the ultimate strategy is, but you're effectively giving yourself more options and more choices by taking advantage of that rise in price.
Yeah, and the other thing that goes with that too is it's not as black and white as that. I mean, when we're talking to clients about it, it's always in conjunction with a whole range of other things that we talk about from a financial planning perspective. But, if you've got secure income, if you've got some cash buffers, if you've got some insurance in place, if you've got all of these things, then it becomes a lot easier to drive up your loan to value ratio, to need to put a smaller deposit down to be able to get into the property market faster, if on balance it suits all of your circumstances. But, you'd never say that to somebody who is bad with money, doesn't have regular income coming in, or, their job's not secure or has no cash savings or no history. So when you look at it overall, it can work, and it does work for the right people in the right circumstances.
Yeah. So obviously, it's going to increase your risk. It's going to have some detrimental impacts, but it's ultimately a matter of assessing the situation and making a decision from all the available information.
Yep. Spot on. The other thing, we've spoken about deposit being a really big hurdle in order to get into the property market. The other side of that coin is your income. And when we talk about income, we're usually talking about household income. So if a borrower or borrowers are fortunate enough where there's two people that are purchasing the property and contributing to the loan, you're taking two incomes into consideration rather than one, which means that you can service a bigger loan, which ultimately means that you can purchase a property that's worth more money. From the bank's perspective, they usually tend to, as a very, very loose sort of rule of thumb, the bank's applying, and this is for a maximum loan amount, but the banks are applying an income multiple to be able to determine what your level of borrowing capacity would be. And generally speaking, we're seeing that it's between 6 and 7 times gross household income as a very rough rule of thumb in terms of what banks will lend clients in a position that, want to borrow money to purchase a house.
Yeah. So effectively what the bank is looking at is, great, you've got the deposit. That could even be at 20%, but are you going to be able to make mortgage repayments at the end of the day? Just because you've got the deposit doesn't mean that you're going to be able to make the mortgage repayments over the course of or over the life of the loan. So making sure that the income that you're earning and to the same degree what your expenses are. So, what they're also looking at is, are you making child support payments? Are you making payments on a car loan or a personal loan? Are there any other expenses that are going to prohibit you from being able to make mortgage repayments? And basically pulling all of that stuff into the blender and determining whether you're likely to be able to service the loan, hence the name serviceability.
And as part of that calculation too, the banks are also applying their own internal metrics as well. They have their own standardized measure about a particular makeup of a household, how much it should be spending on particular things. So if you tell the bank that you spend $50 a week on groceries and there's a household of, 2 adults and 2 children, they obviously know that something's not right there, and they'll apply their own benchmark and metric to what they think that cost should be. So it's not like you can turn around and say, yes, we're only using 10% of our income to live and the other 90% is available to service a loan. That doesn't fly. They're obviously, have access to a massive amount of data, and they apply their own metrics as well too. So income and expenses come into play, and needing to demonstrate a strong, financial management to make sure that the bank has confidence or the lender has confidence when they do give you the money that you can make those repayments and for a substantial period of time. I mean, let's not forget, we're talking about making monthly repayments here for, generally speaking, a 30-year term. So there's a lot of I's to dot and a lot of T's to cross as well.
Yeah. And the thing to also note is that every single bank will calculate this differently. So different banks will have different metrics. So the thing that, I'm a big proponent on, and we are as a firm, is making sure that you're engaging with a professional and you're engaging with a mortgage broker to be able to assess these different options. It's really simple and easy to just look at, all right, what's the best interest rate and just going for that option. But ultimately, if you're not going to be able to get that loan, then it doesn't mean very much. And so what a good mortgage broker should be doing is having a look at first, okay, who's going to offer the loan that we want and who's going to give the borrow amount that's required for this client. And then of those lenders, which is the best product that's available for that client, as opposed to just looking at the best interest rate and not really knowing whether it's going to happen or isn't going to happen from a loan perspective. So every calculator is going to be different. Every bank is going to be different, making sure that you're engaging with a professional that can, again, put all of that information together and assess what the best option for you is imperative.
Just drilling down on that point, Andrew, like with banks, obviously banks and lenders, because they've got a whole range of different people out there that are going to lend money for property purchases, but they have their own policies. And as a borrower, you're never going to know. You're never going to know who's got a policy that's going to suit your circumstances. And this is the reason why, obviously, we're big advocates of mortgage broking, is because a mortgage broker will know which banks, which lenders will have a particular appetite in terms of how their policies sit for a particular lender. So if you go into your bank that you bank with just because you've been with them for a long period of time, you're only ever going to get what their policies are and what their appetite is for that particular loan or your particular circumstances. Maybe you get the loan, maybe you don't. Whereas if you go to a mortgage broker, they should be able to navigate the world of finance with banks and lenders to figure out which lender's policy fits with your circumstances and be able to get not only a greater chance or probability of getting the loan across the line, but making sure that you get the right amount that you need in order to complete that purchase. So going to a mortgage broker should increase the opportunity and increase the chances of you getting a loan for the amount that you need at the most competitive interest rate that's available in the market.
Yeah. And I mean, sort of while we're on that point and while we're talking, again, not just first home buyers, but anyone that's purchasing a property, please get a pre-approval. Please. Just make sure that there's a pre-approval and that you're going to get the loan, because I tell you, it's a pretty stressful time, and it's happened a few times in my career where a client has come in and they've just, gotten excited and purchased the property for whatever reason and don't have a pre-approval in place. But make sure that you're going to get the loan before you commit to purchasing the property.
No, well said, Andrew. You're absolutely right. We see it all the time. You honestly need to start the pre-approval process almost before you need to start looking for property, where it's always the other way around, because you're on realestate.com or Domain and, you see the pretty pictures and you get excited. You're like, oh yeah, there's a property that we want to go for. It's within our budget. We think it's going for auction on the weekend, and they go and see a mortgage broker and expect something to happen on a Tuesday between a Tuesday and a Friday night, so they can go to an auction on a Saturday. But the process does take some time. You really need to go through that process first and foremost before you start getting your hopes up and going and looking at property. Otherwise, you're going to go there and you're not going to have the peace of mind knowing that you've been assessed by a bank and you've got a pre-approval sitting behind you knowing what you can buy for. So yeah, well said, Andrew. Really good point to highlight to our listeners, because we see it time and time and time again. So absolutely.
And Bill's, the other thing that's kind of, in terms of costs, there's obviously some costs involved in terms of, or smaller costs involved in terms of, doing building inspections, making sure that structurally the property that you're purchasing is of sound quality. There's conveyancer costs, which will obviously help facilitate the settlement of the loan. But one of the sort of the larger costs around purchasing property is stamp duty. Tell us a bit about that, Bills.
Mm-hmm, mm-hmm. So stamp duty, in all honesty, is probably the most useless tax that we've got, if I'm completely honest. But it's a tax. And look, we'll talk about Victoria because that's where we are. But generally speaking, you transfer a property from owner A to owner B. The person who's owner B, who's purchasing the property, is gifting the government about 5.5% of the property value. For what reason, I honestly couldn't tell you. I know that we need to keep
Tactfully,
keep the wheels spinning in the economy and stuff like that. But I don't see the connection. But anyway, that's probably for another podcast. We'll wait.
Personal opinion aside, maybe a podcast after we've gotten a couple of whiskeys into Billy.
And without derailing the podcast and without me going off on a tangent and jumping into a fit of rage, we'll just leave that one there. But so stamp duty is a useless tax that you pay to the state or territory that you're in for the privilege of buying property. And look, let's just use some rough numbers. 5.5%. If you're purchasing a property worth $1 million, you're talking $55,000 in stamp duty, roughly. There are some sliding scales, but let's just call it $55,000 on top of the $1 million that you're buying for the property. So you need to come up with that money. That needs to come from somewhere. There are a whole range of government concessions, and there's probably a bigger conversation, but which we might even pivot into now. The government are trying to support people to purchase property, in particular first home buyers, for obvious reasons, because you need shelter and, it's also a great way to grow wealth, and the wealth effect and the household consumption effect when people have increasing wealth, especially through property prices, people are feeling wealthier, they spend more money in the economy. So property is a huge driver in the economy. So the government are really supportive of the property industry just in general for that particular reason. But in order to try and help facilitate first home buyers getting into the market, and we'll talk about the Victorian example, it's different across different states, but there are some exemptions in Victoria to try and waive or at least reduce stamp duty to try and assist first home buyers so they don't need to then come up with that additional money to pay for stamp duty. So in Victoria, if you're buying a property worth less than $600,000 and you're a first home buyer, you're going to avoid stamp duty. You're not going to have to pay it, which is fantastic. So you've gone and saved yourself, what's that? Just over $30,000, which is great.
And this is provided that it's a owner-occupied property. So you're going to live in the property for 12 months.
Correct. Yep. And then there's a sliding scale. So between $600,000 and $750,000, there's a sliding scale. So on the lower end, you're paying less stamp duty. On the higher end, you're pretty much paying full stamp duty. So the idea is it's designed to try and help first home buyers get into the property market a little bit faster. And there's a couple of other incentives. Andrew, the First Home Super Saver Scheme is also available as well too.
Yep. So that's another way that, it can help facilitate getting into the property market faster. Now, it's something that you do need to prep for. So the money needs to be in there for at least a couple of years.
So in there, you're talking about contributing money to...
Yeah. So you can basically contribute additional funds towards superannuation. And within your superannuation fund, there's almost a separation between the money that you can access for the deposit, which is the additional money that you've salary sacrificed and contributed, and your existing superannuation monies that your employer is making on your behalf. So by doing so, and the benefit of contributing additional funds towards superannuation is you're getting a tax deduction on those funds. So if you're earning, again, depending on what your tax bracket is, but if your tax bracket is 32.5%, 37.5%, whatever your tax bracket is, the money that you're contributing towards superannuation is only taxed at 15%. So you're effectively saving tax and it's helping facilitate saving for a property. The money has to be inside of superannuation for 2 years. So you can't contribute additional funds to super, get the tax deduction, and then purchase a property in 6 months' time. And effectively, you have the ability to pull that money out from superannuation and use that for a deposit. So obviously there's, as I said, some intricacies and things that you need to work around, making sure that you're not breaching contribution limits and all of that stuff. So engage with a professional before you actually embark on something like this. But that's another way to help facilitate first home buyers by taking advantage of some tax savings and then pulling that money out and using that for a deposit on the property. Bills, there's also a first home loan deposit LMI waiver. Tell us a bit about that.
So once again, the government has an incentive here to try and help support first home buyers. So they've come up with the first home loan deposit scheme. Essentially what that is if a first home buyer cannot raise 20% like we were talking about for their deposit, they're going to pay lender's mortgage insurance, which goes on top of the loan and adds a greater amount in terms of the repayments. But what the government have done is rather than using a insurer to insure the lender's mortgage insurance, the government are actually guaranteeing that for the bank. So what they're doing is they're guaranteeing for the bank to give them that security that the lender's mortgage insurance would ordinarily give them. And what that's doing for the first home buyer is it's allowing them to purchase a property with a lower deposit while being able to avoid needing to pay the lender's mortgage insurance premium. So basically, the first home buyer still gets to get into the property market without needing to save a bigger and bigger and ever increasing amount. And the bank still gets the guarantee to make sure that if anything goes untoward, that they're covered from an insurance policy perspective. I guess the only thing to say with that is you're going to need to engage on that if that suits your circumstances and if you meet the criteria. You're going to have to engage with that fairly early in the piece, simply because there's a limited number of spots that the government has and they release those every so often. So it's not like this is available to everyone. There actually needs to be spots available in order for people to partake in that. But it's a really good incentive from the government, and it's just another way that the government's supporting people, first home buyers in particular, to be able to get into the property market faster.
Yep. And then in addition to that, I mean, look, those are kind of the majority of the major incentives that are available. There are some incentives that are available that are temporary in nature. So, at the moment, released within the current budget, there's a 50% concession for new residential properties up to $1 million that are within the city of Melbourne. But that's temporary in nature. That ceases after the end of this financial year, or so we're told. But those are the majority of the current incentives that are available in order to be able to help facilitate people getting into the property market faster, and in particular first home buyers as well.
No, well said. And look, well summarised, Andrew. I think we probably covered off on most of the things that we see relevant. Probably the last thing is that from an asset class perspective, so sort of bringing this back to the financial planning discussions that we have with people, property, like any other asset class, there's a worthwhile part of a portfolio that should be invested in property, no doubt. One of the things that I guess makes property very unique is the ability to be able to borrow a significant amount of money to put into that. So you're borrowing, not only are you borrowing 80 or 90% of the valuation of the property, but the absolute dollars that you're investing in to a property are a lot higher. And what that means is if using some really rough numbers, just so I can set myself up to make the calculations easier, but if you invest in a property that's worth $800,000 and you get a 10% rate of return, you're talking about an $80,000 rate of return. Whereas if you buy $50,000 worth of shares and you get that same 10% rate of return, you're only talking $5,000. Percentage-wise, they're both the same. But from an absolute return, property, because you need so much money to get into it and because it's worth so much, the absolute return is a lot greater. So we're finding that over a long period of time, as you start to extrapolate out these numbers and where the growth of a property can go, with the assumption that you're going to get to the end of a loan term and have it all paid off and not have any debt associated with it, you can see where back in the day people bought properties for $100,000 and now they're worth $2 million. So if that continues, then properties are a really great vehicle in a diversified portfolio to be able to grow your wealth.
Exactly right. And the example, and look, it's much too complicated to try and explain it over a podcast, but if you run a calculation on exactly what Billy was saying, an $800,000 property, and even let's just say having a 10% deposit, you run an example of putting 80 grand plus the stamp duty that you're going to pay as well into shares. And I'm not picking on shares or anything, because anyone who's a client of 360 or listens to any of our podcasts knows that we're big proponents of having a diversified portfolio and having shares or having a variety of assets. But if you consider a share portfolio that's 80,000 plus whatever associated stamp duty is on that $800,000 property, even at a higher rate of return, so even if we're talking a rate of return of 10% on a share portfolio versus 6% on the property, the fact that you're borrowing and leveraging an asset that's worth $800,000 as opposed to an asset that's only worth $80,000, that's what's resulting in a absolute dollar value of significantly higher rates of return. Mindful though, that that's also the exact same thing if the property market moves the other way. So if the property market doesn't continue on its current trajectory, and that's an important thing to note, because
property never goes down, Andrew. What are you talking about?
And that's the majority or that's the mentality, especially in Australia, because it's been so long since we've actually seen a sustained decline in property prices. But if it does go the other way, you're exacerbating your losses as well. So yes, the power of debt, the power of leveraging is making absolute dollar rates of return significantly higher on the upside, but it's also doing the same thing on the downside. And that's where the piece around diversification, the piece around having, a multitude of asset classes as opposed to just being invested in one, so that you can reduce the risk, diversify your investment, and have a greater amount of options, because different asset classes will have different benefits as well.
Andrew, really valid point. And I think that pretty much summarizes everything that we wanted to talk about. So hopefully we got across to the listeners everything that sort of we think about and discuss with clients regarding property purchases, some of the barriers to entry and why it's so difficult to get into property.
Yeah, thanks very much for another podcast, Billy. It's always a pleasure and looking forward to the next one.
We'll catch you guys on the next one. Thanks to our listeners.
Thanks very much.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.